Well, hi everyone, Shaun Humphries here. Welcome to All Things Retirement. Well, in this video, I'm going to cover off a specific concern that many people who are not retired yet but getting closer to retirement have. And that concern relates to the fact that they're looking at their paycheck, their annual income on a pre-tax basis, and then they're doing a back-of-the-napkin calculation on their pre-tax income when they retire. And they're looking at a pretty significant gap between those two numbers. They're making way more pre-tax when they're working than what they think they'll generate when they retire. So it creates some anxiety. Well, at the end of the day, I don't think that anxiety is justified. I'm going to cover off an example about what the reality might be for many people. So I think you'll find this video encouraging. And before we get into the content, again, if you haven't subscribed to the channel, make sure you do that so you don't miss future content. We post content on a regular basis on various aspects of retirement planning and overall wealth planning. As well, if you're looking to get a retirement forecast, go to the show notes. There's a link back to our website where you can find out how you can get a complimentary retirement income planning forecast. And there are links to free retirement planning resources. So let's look at a specific example to illustrate this question and potential concern. So we've got a paycheck here. The gross income is $6,000 per month. The tax on this income each month being remitted to CRA is $1,237. You look at CPP and EI contributions, $255 per month. Contributions or payments to the group health plan, $213 per month. A pension plan contribution of $270 per month, and group RSP contributions of $250 per month. So that's not uncommon. You look at those deductions. Many people would have those similar deductions off their paycheck every month or every pay period. And so if you look at the $6,000 of income after deductions, this individual's netting $3,775 per month going into their checking account from their employer. Now, when they did the back-of-the-napkin calculation, at age 65, they were forecasting that their pre-tax income would be approximately $4,000 per month. We calculated the tax bill in the range of $649. And keep in mind that when people retire, often they are dropping a tax bracket, and there are additional tax credits as well as potential income splitting if they have a partner. So their net after-tax income is going to be $3,351. So this is where these calculations become really important. So right now, the income is $6,000 at age 65. They're forecasting $4,000. Their concern was justified. That's a 33% reduction in gross income. And yet, their net income is going from $3,775 to $3,351, a reduction of 11.23%, not nearly as extreme as the pre-tax income reduction. So it's not perfect, but you can see it's not a dramatic reduction in net after-tax income. And if they do it in advance in terms of their planning, they probably can make up for that reduction through drawing money from their RSP accounts or other investments that they might have in place. This is why focusing on net after-tax income is so important. And the value of doing financial forecasting for retirement is you can dial into these numbers to see where you're tracking, and if there is a deficit, what you can do to make up that shortfall. Anyway, I hope you found the video helpful. If you are not subscribed to the channel, make sure you do that so you don't miss future content. If you're looking to get a forecast, a complimentary forecast can be obtained by going to our show notes. There's a link back to our website to find out how you can obtain that. Anyway, wishing you all the best in your retirement income planning and overall wealth planning journey. You take care. Bye-bye.